Hi, in this video, I'm going to discuss the mechanism of short selling in a margin account, how much deposit you need to make against a short position, and when you receive the margin call. As we all know that short selling is done in a bearish market when you expect the stock price to decline or continue to decline. Short selling in a regular cash account is easy and simple. Short selling in a margin account, however, is relatively complex because it involves borrowing part of the money from the broker. Let's take an example and try to understand its mechanism in different situations. You are bearish on telecom and decide to sell short 100 shares at the current market price of $50 per share. Question number 1. How much in cash or securities must you put into your brokerage account if the broker's initial margin requirement is 50% of the value of the short position? So the short sell proceeds is 100 times 50 equals 5,000. Since the broker sets an initial margin of 50%, you need to have 50% of 5,000, which is 2,500 in the account as a deposit. Question number 2. How high can the price of the stock go before you get a margin call if the maintenance margin is 30% of the value of the short position? Cash from short sell equals 5,000. Security deposit, which is your equity, is 2,500. Total asset in the account is 5,000 plus 2,500 equals 7,500, in which 5,000 is your liability and 2,500 is your equity. Let's assume that you receive a margin call when the price increases to P. At this price, equity in the account would be 7,500 minus 100 times P. P is unknown. Liability in the account would be 100 times P. Now solve the following equation for P. 7,500 minus 100P divided by 100P equals 0.3, which is a maintenance margin. If you solve this equation, you get P equals 57.69. Hence, a margin call will be issued when the stock price reaches 57.69 or higher. Please note that short sell mechanism explained above is a reverse of a regular cash account transaction. Thanks for watching this video.